It's midterm election day. What does that mean for markets going forward from here? That's coming up on 3 Minutes on Markets and Money. Yesterday, markets rallied here just a bit, coming off that important 20-day moving average. Again, holding that support level. That's been kind of critical for the markets here over the last couple of days in particular. Following Powell's more hawkish comments following the FOMC release last week. On Thursday, though, we have the next CPI report. So again, that could weigh on stock prices if that number comes in a lot hotter than expected, of course, encouraging the Fed to continue to hike rates. But for right now, the entire focus for the markets today is on the outcome of the midterm elections. Of course, what Wall Street wants is gridlock. So if Republicans take the House, the Senate, or both, that again suggests that policy changes in Washington will be hard to come by to try to get the president to agree to whatever the Republicans want. That's not going to really happen. Market likes that because, again, don't have to worry about higher taxes, more deficit spending, out of control policies of some sort or the other. Puts a lot of that to rest and allows the market to focus on earnings, economic growth, and the things that drive stock prices over time. Markets rallied yesterday on expectations Republicans will take at least one House of Congress. That kept, again, the markets right here above the 20-day moving average and actually got above, just a smidge above the 50-day moving average. So again, a rally today will get us clearly above that 50-day moving average. That brings back into focus these recent tops, which also corresponds with where the 100-day moving average is as well. Again, that's going to be the first level of initial resistance. If markets can work the way up through that, we've got a challenge here of around 4,000 where we're going to run into the 200-day moving average, but that'll be a little bit later on in the month if we start to get there. Again, there's some reasons to expect the market can rally here over the next month or two as we move into end of the year. Buybacks back in play now. But also we've got repositioning of pension funds, hedge funds, mutual funds, getting cash on their books invested back into equities for year-end reporting. So there's a couple of things that could push asset prices here over the next couple of weeks. But again, want to use that as an opportunity to reduce risk, raise some cash in portfolios, rebalance equities, because as we get into next year, we still have to deal with 3 full percentage points of rate hikes that haven't even shown up in the economy yet. And we've got more rate hikes on the way. 50 basis points in December, 225 basis point hikes in the first of next year. So again, all that economic drag from higher rates still going to weigh on earnings, forecast, outlooks for companies. That's going to continue to put pressure on asset prices near term. So again, continue to rebalance that risk accordingly. The good news out of all this is that markets really haven't gone anywhere now for the past several months. We've just continued to base here. That's actually kind of a positive sign for markets. It doesn't necessarily mean we're in for the market lows, but it's been important that the markets haven't continued to break down to new lows. So again, markets are trying to stabilize here as we continue to process this news about higher interest rates, higher inflation. A lot of this is built all on hopes that the Fed's going to pivot sooner than not, but we'll see when we get there. Again, pay attention to what markets do today. We'll be back here tomorrow to update you with election results and what that might mean for the markets going forward. See you then.